Greetings once again, everyone. Despite bold claims on the part of some commentators that the worst of the euro crisis is now over, I still very much beg to differ. I would go so far as to say that the crisis in Euroland is still only halfway through running its course, and some regions will still not have fully recovered from its effects 15 years from now. Of course, this prediction presupposes the authorities somehow succeed in keeping the single currency bloc in one piece. However, it's hard to see how this can be achieved, since Greece, for one, is now in its 6th year of recession/depression, with its economy still shrinking markedly. The other peripherals are in little better shape, and now we face the spectre of an imminent full sovereign Spanish bailout. Remember, it wasn't long ago that a Spanish bailout was thought impossible. People who did the sums told us that Spain was simply too big to bail. More on that in a moment, but first to matters closer to home. Why are the banks still not lending? They've been gifted shed loads of cheap money over the last few years from central banks to buy the bonds of those banks to shore up their balance sheets. So what could still be the problem? Well, there are two massive dangers at present from any institution whose core business is lending money. The first one is the very real risk of a sudden nosedive back into severe recession, making it much more likely that prospective borrowers will default. The second is the nightmare of hyperinflation resulting from too much monetary easing worldwide. Neither of these prospects is likely to entice the banks to lend. In the case of a return to recession, and I mean a severe recession here since we are already technically in recession again, the risk is loan default. In the case of hyperinflation, it's that lenders will get back sums that are cents on the dollar in real terms compared to what they originally loaned out. Remember that high inflation is the enemy of lenders and savers. The real winners in times of high inflation are borrowers locked into low nominal interest rate contracts. In fact, we could conceivably be entering into an extended phase of differential inflation of the kind we have not seen before, where the price of everyday items such as food, clothing and energy increase markedly, whereas the value of large purchases, like flats and houses, which typically require borrowed money, remains largely stagnant. Just imagine how much it would cost to buy a house if there were no mortgage finance at all and one had to save up, as in the old days, to make the purchase. Prices would have to adjust downwards to compensate for a vastly shrunken pool of finance. This is the folly of mortgage finance. Much of the benefit of making housing affordable for those with limited savings by extending loans to them is wiped out by the higher prices such finance inevitably generates. Anyway, before I stray off the point, just keep an eye out for differential inflation as long as the banks aren't lending, and try to profit out of it if you possibly can, because the opportunities from profiting from the more conventional ways in a normal healthy economy that we once used to know are vanishing fast. Why do I say this? Obviously, if you're an employee or a small businessman, you won't need an explanation. It's tough out there right now, and it has been for the last few years. But those of us who prefer to earn a living with our feet up, things are no better. Once upon a time in the increasingly dim and distant past, we would review our portfolios on a yearly basis and make whatever acquisitions and disposals we deemed necessary. The world was so much simpler back then. Sadly for us today, the two main historic asset classes for investors have become no-go areas. I'm speaking of equities and bonds. The returns on both of these have been hopeless now for quite a while. Plus, whereas we used to be able to think of bonds, investment-grade bonds at any rate, as essentially risk-free, the same can no longer be said for them today. The risk of sovereign default is ever present, as is the risk that the ECB will, given a serious enough credit event, prove unable to backstop the government debt market. This is only a very recent phenomenon, and the thought of sovereign bonds defaulting just a few years ago was unthinkable. In short, both bonds and shares have become uninvestable asset classes. Share volumes have been extremely thin lately, and active investors, or traders if you prefer, have been making 40% fewer transactions of late. Mergers and acquisitions, the core business of the merchant banks, continues to be very much depressed. Hardly surprising when there is so much uncertainty surrounding Europe's future. There's real fear in the air. And there's not really much in the way of alternatives. Cash on deposit in a bank or building society account doesn't keep up with inflation, and there's the additional risk of bank failure. Granted, there are deposit insurance schemes for such circumstances, but can we really trust them to make good in this environment? Cash under the mattress may or may not be safer depending on where you live, but it doesn't even attract the derisory rates of interest that bank deposits offer. The one refuge in all this doom and darkness is gold and silver, which a lot of crazy hotheads have been endorsing for a while now. Well, good luck to them. Perhaps they're not so crazy after all. Anyway, returning to the basket case Eurozone. What's the latest, I hear you ask? Well, the action at present is centred around beleaguered Spain, which, as usual nowadays, is in terrible trouble. Many of my subscribers will be unaware, but Spain released its budget for the coming year last week. You will probably be more familiar with the violent demonstrations that ensued than the contents of the budget itself. But suffice it to know that this budget was tough. It was not a budget for growth, it was a budget for austerity. And Spain, like Greece, with 1 in 4 of the working population out of work, has had a belly full of austerity. Yes, the measures were pretty hard to swallow, but there was a reason for this. The Economy Watch is certain, following a denial by the hopelessly bad liar Olli Rehn, that the budget measures were drafted in Brussels with the full prior approval of the Eurocrats. This paves the way for Spain to apply for a full bailout without the humiliation of having any support package only being advanced subject to preconditions. This was a face-saving measure designed to curb the outrage and indignation of the Spanish people. So when you see Spain going cap in hand to the EFS at some time now, you will know that the claims of the Euro supporters that the worst of the crisis is over are utter rubbish. As if this weren't enough, Spain now faces the possible breakup of her regions. Catalonia, the wealthiest of Spain's autonomous regions, comprising Barcelona in the northeast and the largest contributor to the country's overall tax take, has had enough of playing paymaster and having its productive resources siphoned off by the central government, and has decided to hold a referendum on independence next month. If this proves successful and the region goes its own way, then this will leave an even larger fiscal gap for Madrid to plug. Add to this the record capital flight now being experienced by Spanish banks, and you can see that the 60 billion euros earmarked by Brussels for the bailout will almost immediately prove insufficient to keep the country and its banks afloat. So the imminent bailout could prove to be only the first of many, further exacerbating relations with Germany and the other northern ATM countries. One last thing, speaking of Germany, which is itself now struggling to grow, and that is simply to pose the question as to how long it will be before Bavaria, Germany's nearest equivalent to Catalonia, tires of being similarly leaned on for its tax revenues, and the forces of separatism become impossible to ignore there too. Recall it was the historically insular nature of the Bavarians that Hitler was able to nurture and exploit in the 1930s, and we don't want any repetition of that scenario, thank you very much. Sadly, however, as I've remarked here before, the current crop of Eurocrats and German politicians have displayed an astonishingly careless attitude towards the likely political consequences of their endless demands on Europe's largest economy. Once again, it seems the only guaranteed winners out of this ongoing financial train wreck are Europe's far-right and separatist movements, among which there is no lack of growth. So in closing, I would like to wish you all the best for the final quarter of 2012. It should prove a very interesting few months, not just in Europe, but in the US and China as well, where there is much indeed to keep an eye on. Interesting times for sure. See you again next time.